Welcome to Module 1 of the IFRS 9 PIT PD modeling course. And in this module, we'll introduce the fundamentals of IFRS 9 and point-in-time probability of default. By the end of this session, you'll understand the key concepts, regulatory requirements, and how PIT PD fits into the expected credit loss framework. Learning objectives. By the end of this module, you will be able to 1. Understand the core principles of IFRS 9 financial instruments. 2. Distinguish between point-in-time, PIT, and through-the-cycle, TTC PDs. 3. Explain the IFRS 9 three-stage impairment model. 4th, identify key triggers for significant increase in credit risk, SICR. 5. Appreciate the critical role of PIT PD in expected credit loss calculation. IFRS 9 overview. IFRS 9 is an international financial reporting standard for accounting of financial instruments. It replaced IAS 39 and introduced a forward-looking expected credit loss model, effective from January 1, 2018. The standard aims to improve the timeliness and accuracy of credit loss recognition by focusing on expected rather than incurred losses. The IFRS 9 three-stage model. The impairment model divides assets into 3 stages. Stage 1, performing assets. No significant increase in credit risk. Recognized 12-month ECL. Stage 2, underperforming assets. Significant increase in credit risk. Recognize lifetime ECL. Stage 3, defaulted assets. Objective evidence of impairment. Recognize lifetime ECL and calculate interest on the net carrying amount. Significant increase in credit risk, and in SICR. SICR assessment determines whether an asset moves from Stage 1 to Stage 2. Quantitative triggers include PD increases above a defined threshold. Qualitative triggers include loan restructuring, covenant breaches, or adverse borrower events. The backstop provision requires that loans 30-plus days past due be classified as Stage 2. PIT versus TTC PD. Point-in-time PD reflects current and forecasted economic conditions, making it sensitive to short-term changes. It's used for IFRS 9 ECL calculations. Through-the-cycle PD represents a long-term average over economic cycles, less sensitive to immediate changes, and is often used for regulatory capital models under Basel III. Role of PIT PD in ECL PIT PD is a core input into the ECL formula. ECL equals PD times LGD times EAD. It captures the probability of default over the required horizon and integrates macroeconomic scenarios for forward-looking compliance with IFRS 9. PIT PD development workflow. The workflow includes 1. Data management, sourcing, cleaning, and transforming internal and external datasets. 2. Variable selection, identifying key predictors, including WOE binning. 3. Model estimation, applying methods like logistic regression. 4. Validation and calibration, ensuring accuracy and consistency. 5. Monitoring and integration, performance tracking and embedding into IT systems. Worked example, logistic regression. We'll demonstrate using logistic regression to predict 12-month default on a synthetic loan-level dataset. Variables include borrower demographics, loan characteristics, and economic indicators. We'll review coefficients, odds ratios, and resulting PDs, linking them to macroeconomic drivers. Module summary and next steps. Key takeaways. IFRS 9 requires forward-looking ECL, with PIT PD central to compliance. The distinction between 12-month and lifetime PD depends on staging and SICR assessment. Next, in Module 2, we'll cover data preparation, validation, and transformation techniques essential for building a robust PD model.